Hi, Rob Mitchell here. Thanks for joining me for part two in a series that I'm doing here on what makes the best day trading strategies, the best day trading signals, and the best day trading systems. Differences that make a difference, day trading. Yeah. So let's continue and take a look. First off, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Don't use the grocery money to trade. Yeah. In the previous video, part one in this series on this channel, what makes the best day trading indicators, we covered the following key concepts as to what makes the best day trading indicators. Most indicators I submit are random, unless you can map them to have certain probabilities for certain contexts. Indicators become non-random, or they can become successful intraday trading strategies for specific reasons. It doesn't generally happen by accident. They have the right principles behind them. Yeah. So an indicator should be able to produce a known outcome for a given pattern on the indicator. And further, I submit it should be able to stand on its own, not combining it with a bunch of other things. Yeah. Or at least keeping it very simple. Yeah. The simpler, the better. So successful indicators should be able to give you a probability for continuation or to give a forward prediction over a range of price bars in any direction that the signal might be going. Yeah. So the best indicators for day trading follow these principles in the creation of the best day trading signals, day trading strategies, and day trading systems. So in this video, part two, we're going to cover what makes the best day trading strategies, what makes the best day trading signals, what makes the best day trading systems. Yeah. And we're going to do this by combining signals together or strategies and systems from the previous video using the same exact tests that we did there so that we get what we generally call probability stacking. Yeah. This method of trading system and strategy design makes the best day trading strategies, signals, and trading systems, leading to what I've often called super systems. I believe the very best trading systems are designed based on the concept that we're covering right here in this video. So when we combine our strategies and systems in the way that we just described, we get theoretical probability stacking that opens the potential for better chances of success or improvement on a day trade that we're taking. Yeah, this concept works in conjunction with a concept from Bayes' theorem, which says in its simplest form for our purposes, just kind of summon this together as a rule of thumb, if we get two signals, each of which is 75% to continue or to success, we expect to get 90%. So those signals combine and get a higher probability. If we get three of them that all line up for 75%, we get 96. If we get more, we get more. Yeah. In this video, we're only using three components, and many of them will not line up, as you'll see as we do this and we see the result. In our trading room, sometimes we get as many as 7 or more of these things lining up all at the same time, and there's different forms of them. Ones that push, one that pull, and different kinds of signals. And this can theoretically improve things even more over having just 2 of them line up. So for this video, we're going to do where 2 of them line up. And we're demonstrating an overall general concept here for stacking, as we're calling it, probability stacking, starting from what were already high numbers from the previous video and the tests that we did there. Yeah. So what is Bayes' theorem and why is it important? I got turned on to Bayes' theorem originally from Nate Silver's book, The Signal and the Noise. And I actually was suggested that I read that from a friend of mine who currently manages a hedge fund. And it was interesting because I read it, and then the next time I touched base with him, I said, hey, did you read that Signal and the Noise yet? And he goes, no, I haven't read it, but everybody's saying you got to read it. And so I took these concepts and applied them about the time that book came out, and this is what generally, the way I taught it, it all comes together. So if you've got two things that line up in time simultaneously that are proven to happen 50% of the time towards a certain specific outcome, what's the chance that the certain specific outcome happens? You combine two of them and each of them are 50%, you get 50%. Yeah, so Bayes recognizes that 50% is 50%. It doesn't matter if you put 100 of them together, it's still 50%. Well, how about if those two signals, or whatever you want to call them, the two things that are happening simultaneously, this key word here, are 60%. Well, then you get 69%. So from the original random of 50%, we gained, I get that right now, we gained 9 with 10 of them. Yeah, so I stand corrected on that. Yeah, how about 75%? Yeah, we're 25% above the 50, 25% above the 50, and we gain 15 there. I need to adjust these numbers. Yeah. So how about if two of the signals are 90%, two of them are 90%, we'll get 40 and we pick up 9% there. Yeah. So don't use those numbers that are there, adjust them in your mind. Yeah. So where do the biggest jumps occur? Yeah, where do the biggest jumps occur? So let's take a look at that. If the big jumps occur early on, then if we had multiple of them all lined up, then they would increase the chances of completion substantially. Yeah. So what's the lowest number we might choose to be doing this Bayes theorem? Since 50% gets us no benefit, like I said, if you add 100 of them together, you're not going to get anything better than 50% theoretically. So I say about 68%. Yeah. And what are two 68%? When you combine them together, you get about 82. So you get a jump there. Yeah. What are two 75s? 90. Yeah, we just looked at that. And what are three 96%? So see what's happening here is you jump 15, you jump then 6, then 3, then 1, for each of these successive. So 75, you get 3, you jump 6, and then you jump 3. If you go another one, you jump 1 if you get another one. So why is that important? Yeah. So what happens if you have 3 things lined up at 75? You'd have 96%, and one of them fails. You still have 90%, right? So that's super important because we are designing our system based on 3 individual components, each of which stands on its own. If one of them fails, I still have 90%. Now, so 1/3 of my system failed the 3 components, and I still have a 75 or a 90% rate to win, or to follow through, if you will. So what if you have 4 of them lined up and one of them fails? You still have 96%. What if you have 5 of them lined up and one of them fails? You still have 99%. So you see what's happening here? By having each of these individual components all lining up at the same time, it doesn't matter if even, if I got 5 of them, it doesn't even matter really if 2 of them had completely failed. I still have a really high probability for the follow through. So what are we really looking at? Yeah. So I might call this the amplitude of nature. A fancy term there. Functions based on things lining up. When things line up in nature, they tend to happen. When they're lining up at the same time. The same principle applies. Like if we look at different theories and system design, cycle theory, finding dominant cycles and things like that, which we use in trading, and indicator design. Yeah, the same principle applies. When things line up, they tend to happen. I could probably do a whole webinar on that concept of cycle composition. But that's beyond the scope of what we're doing right here. I just kind of threw it in there as a sideline. When if you got a bunch of sine waves on a page, and at certain points they're all going to line up. Yeah, and where they line up, you're going to get the strongest signal. Yeah. So it's the same concept. But what would happen if all of our indicators were built from these kinds of principles that we're talking about going forward? Yeah. Would it be possible to get random results? Well, as we just said, if 2 of them failed and you had 5, it'd be really hard for it to fail if you're designing based on this principle that we're describing here. Yeah, stacking simultaneous signals. So given this discussion, designing trading tools around these kinds of concepts, and then the way which probabilities can stack, does the issue of trading system robustness even matter? A lot of times in discussion about, oh, is a trading system robust? But when we design in this matter, in a manner that we're describing here, it may become much less of a significant thing based on a good design. So what we're really talking about is good design. And so what's the probability I could design a bad system, I might ask, given these parameters? So it gets even better, however. This is something I've been working on a lot recently in the last 6 months or so. The probabilities from prior bars stack with current ones in what I call progressive probability stacking, and we'll do a future video or webinar on that concept. Yeah, so be sure to subscribe to the channel here to be notified of that video or webinar when it's released. I click the subscribe button there. Yeah. In the previous video in this series, we had 3 patterns that we tested using smart trade markers. Yeah, we had the hook a yellow pattern, we had a 2dB pattern, and we had the 3D patterns. If you haven't seen that video, you might want to go find it. This is part 1 on there. And the previous video for more details on those specific patterns and how we did them. We've got many of these patterns that we use. I just picked those, not for any particular reason. It just happened to be what I saw first when I was putting that together. On just our trap trader oscillator alone, we probably have in excess of 30 patterns. And then if you consider the different combinations of them, way more than that. Using the yellow ticks and things like that, it jumps it up even more. Yeah, so there's all kinds of patterns that we have that we do these. These were more or less randomly selected just based on what the first thing I saw when I looked at the chart. So we had the hook yellow pattern, and this is from the previous part 1. All these are just kind of going back over it from part 1. So I'm just going to go over these. Here's a 2dB pattern from part 1. That we trade in our trading rooms every day when we have them, hook a yellow, 2dB, and the 3D pattern. The 3D pattern we've been doing for years and years and years. There's nothing new about that one. And so using smart trade markers, here's what we're going to do. We're going to take the test from the last video. I saved them in trade markers, and I'm going to load all of the signals onto the same chart. Which is something I can do with trade markers. Very powerful feature to be able to load multiple systems together onto the same chart. And then what I'm going to do is I'm going to use trade markers, and I'm going to remove all the signals that do not have at least one other of them that lines up, because what we're talking about is signals that line up here. In trading, sometimes we call this confluence. I usually use that term with the notion of support and resistance. We're essentially talking about confluence of signals here. Yeah. So I'm only gonna leave them on there if at least 2 of them line up. At least 2 of them line up. If they line up, then I should get probability stacking, as we discussed, and get an overall general better result. Now, because of the ones I chose, the 2dB and the 3dB and the 3D patterns are exclusive, so I can't get more than 2 on this test. So using the individual methods, we had overall win-loss percent of 74%, 88%, and 80% based on the tests that we looked at just a minute ago from the prior video, respectively, with expectancy of the trades of $95, $206, and $109 over 270 trades based on 3 contracts over 5 trading days. So what we're going to do here is we combined them together using trade markers over 5 days. And we remove the non-simultaneous ones as we've described. And this is what we got combined. Yeah, combined over the 5 trading days. Yeah, we have an expectancy of 196. This has commission coming out of it. And 93%, 88%, and 79%. There's a number over here on this right edge here called edge 1, 2, and 3. This is a system metric that I developed that tells us the amount by which we are exceeding break even. Yeah, there's a 13% on the first one, 21% on the second one, and 21% on the third one. What's interesting about that is if you have any experience with business, most businesses that operate like with employees and brick and mortar and insurance and utilities and all kinds of things operate on a margin of just a few percent. We're talking about many, many times that kind of a thing. Does this guarantee that you should just be successful doing this? It does not. It does not. However, it does tend to stack things in your favor. There are many things that you develop in your skill set as being a successful trader. This is just part of it. Yeah, just part of it. Past performance is not necessarily indicative of future result. In the last video, I used this break-even stop right here, and I didn't do it here because I wanted to see what those edges were going forward. I could have checked that and have it shown me that. It would have made a little bit less, and it would have locked all these percentages at 93% for all 3 legs. Yeah. Let's see if there's anything else on here that I'd like to cover for you. I think that's it. Yeah, that's it. So by combining, what did we get? We got less than half as many trades. Yeah, half as many trades. Our broker might not like that, but we would like that. Yeah, half as many trades, while at the same time we increased profitability over any of the individual tests by more than double. Yeah, by more than double. Half as many trades, double profit. We'd expect to get a better win percent, but since the win percent for the test were already crazy high, 93, 94%. When we previously mentioned using a baseline of 75%, we got higher numbers for this. And so we didn't increase there too much. It's about the same. We stayed close to the original 93% level on the first test and the best results for successive targets. So if we introduced more signals that we have in our trading room, and like I said, on the Trap Trader Oscillator Advanced alone, we look at like 30 different signals that you could potentially use. Some of them happen more often than others. We'd expect to get better than what we got here. Yeah, and so for this test, we can't get more than 2, as I previously mentioned, because the 3D and the 2DV patterns are exclusive. They can't both happen at the same time. The probability we improved robustness, as we already described, is also high. So combining the signals, we're aligning with known principles for building super systems for day trading. And essentially, we're using Bayes' theorem to do that. Now, you could have traded the individual day trading signals themselves. That's perfectly all right. However, the probability, let's say you were trading that and one of them was failing. Yeah. And we already covered that. And so trading in this way, the combining of it is more robust. Things are stacking more in your favor, more and more in your favor with each successive simultaneous signal that you're doing. You can also get sequential probabilities, but that's beyond the discussion of this mini webinar here. Yeah. So the best day trading strategies for day trading following these principles that we've covered in the creation of the best day trading signals, the best day trading strategies, and the best day trading systems is what all this boils down to. Yeah, so the subtle distinctions that we've demonstrated in this video are what we believe to be a difference that makes a difference, as we said in our original webinar title screen. Yeah. When it comes to the best day trading signals, tools, indicators, systems, strategies, and patterns. Yeah. There's many other patterns that we teach in our trading room involving what we're discussing in this video. And there are many more signals on the charts that did line up, but we did not discuss them in this video because I wanted to keep it narrow down to those three basic things. Yeah. So we're simply demonstrating an overall general concept in this part 2 of the series, what makes the best day trading strategy, signals, and trading systems. Yeah. The day trading tools that we used as part of this are part of the Smart Patterns trading system from Indicator Smart. Yeah. These tools are designed to have exactly what we're discussing here. Yeah, they're non-random because they're based on principles that are boiled down to the way the market works. Yeah, that's not by accident. So many of these have exceptional theoretical historical hit rates, predictive value. Again, past performance, not necessarily indicative of future results, but many of these patterns, we've been watching them over and over and over again for years and years and years. We're coming up, well, right now is about 8 years we've been doing these in the trading room. Yeah. And or over the last 8 years that we've developed many of these methods and techniques. So trading this way, there's nothing like it. You know, it's a different kind of thinking. And this is a type of trading strategy system design that's inclined to stand the test of time for the reasons that we discussed, much better than traditional ways of building trading systems because each statistic stands on its own independently and are based fundamentally on the way markets work. Yeah. So to see these concepts in action with many multiple simultaneous potential signals, join the trading room. Come join us over there. I want to give you some links in a minute, and check us out at Indicator Smart for more on the Smart Patterns trading system and components. The trading room is a live application of these and other concepts. You know, we're discussing it live while it's happening, and other trading concepts and methods and all kinds of things related, all manner of things related to trading. We think it's the best way to learn and advance your skills and knowledge in such methods and contexts that can work in any reasonably volatile market. There's some recent member comments and reviews that have been sent over to me using these methods, and learn about the tools we've discovered at indicatorsmart.com and the trading room where I train, oiltradingroom.com, and be sure to join our mailing list and subscribe to the YouTube channel, again, to keep informed of more systems and methods. I'd like to thank you for joining me today for this brief mini webinar on what makes the best day trading strategies, signals, and trading systems. Thank you, and we'll see you again soon.